Hi everyone, and welcome to the first of our WealthTracker Video Series. I'm Jeff Greenfeld, an investment advisor with Greenfeld Financial Management and IA Private Wealth here in Delta, BC. Today in our first video, I'll address the market turmoil that we're currently experiencing. Now, market turmoil is nothing new, and as has been in the past, it's always followed by a robust recovery. In just over the last decade, we've seen 4 instances of severe market turmoil. The first one was the great financial crisis of 2008. This was a global credit and liquidity crisis that was triggered in part by the collapse of the U.S. mortgage-backed securities. The second one was the European sovereign debt crisis of 2011. That's where there was a widespread concern that Greece, Italy, Portugal, Spain, and Ireland could all default on their government bonds. The third one was the oil crash of 2015. This oil crash was very unexpected, and of course it caused a severe drop in oil prices. And the fourth one was the 2018 fourth quarter interest rate panic, which involved a series of U.S. Federal Reserve rate hikes that the market viewed as unjustified by economic conditions. While each of these had its own set of unique causes and consequences, they all shared one thing in common. They were followed by dramatic rebounds. So there's no reason to believe that the current crisis will be any different. Naturally, it's difficult to think this way in the midst of extreme downward volatility. I admit that the seemingly endless stream of bad news and pessimism is difficult to tune out. But we will get through this, and when we do, those investors who hold firm to their long-term plans will likely be rewarded, and those who decide to sell out to cash and rush for the exits in fear will lock in their losses during this down market and will wish they had hung on just a little longer to see things turn around. I want to share with you some tables that show what happened across a variety of asset classes after the last 4 market crises. There is some variance depending on the asset class and the nature of the crisis, but again, the story is the same in one important aspect. The markets recovered what they lost and grew very nicely from there. So let me bring you to the first chart. Now, this first chart looks at the great financial crisis of 2008. On the first line, you can see the U.S. equities took a downturn of 51%, but recovered by almost 54% 1 year later. Midway down the chart, the more conservative investments like global bonds that did less than 1% rebounded close to 14%, and even high yield bonds that lost 26% also bounced back 1 year later by over 57%. As you can see in the 3-year, 5-year, 10-year columns on the chart, the markets fared very well after the year of down markets on a cumulative basis. Now, I want to bring you to our next chart, and I just have to adjust the screen. There we go. This second chart I'm showing you shows the 2018 fourth quarter interest rate panic. In 2018, by raising the federal funds rate, the central bank increased the cost of borrowing money, which clearly discouraged spending. This was done to help reduce inflation, very similar to what's happening today. The 2018 interest rate panic saw the market go down between 1 and 13%, as you'll see, only to see gains 1 year later of up to 27% for global equities and almost 7% for the global bonds, as you'll see here on the chart. Now, yes, the current situation is tough to stomach, I realize, but it's nothing new. As has happened in every past instance of the market turmoil, we believe we'll see a recovery and continued growth beyond the previous highs. Now, I'm going to continue to address the current market conditions over and other WealthTracker issues in my next videos, but in the meantime, please do feel free to reach out to me if you'd like to discuss the current market conditions or if you have any wealth management related questions. Thanks for listening today. I look forward to bringing you more insights on my next video in our series, and have a great day. Bye for now.